Are whispers of a 2024 housing crash just rumors? Or is there real truth hiding behind those headlines? It's a world filled with speculation and uncertainty, but we're here to sift through the noise and find the facts. You're in the perfect spot if you're an investor, a builder, or simply dreaming of buying your own home or getting rich. In this video, we'll guide you through the key signs and signals of the housing market's health, from the roller coaster of mortgage rates to the pulse of consumer confidence and the tug-of-war between supply and demand. So stick around as we decode the market's signals together and offer a roadmap to getting rich during the housing market crisis. Why do housing markets crash? But before we unravel the mysteries of the housing market, we need to tackle an important question. Why do housing markets crash? Housing markets don't just fall apart overnight. There's always a buildup, a series of events that push the market to its breaking point. What usually kicks things off? A mix of low interest rates, a spike in jobs boosting demand, easy credit, and sometimes even inflation. Put these together and you've got yourself a housing bubble. But just like any bubble, take one element away and pop, it's all coming down. Interest rates shoot up, jobs vanish, loans become a treasure hunt, or the economy hits the brakes hard. These are your red flags signaling a downturn. As whispers of a 2024 crash get louder, everyone from investors to builders is scrambling for signs. What's the pulse of the market? Here are a couple signs to watch out for. Inflation and mortgage rates. Inflation plays a significant role in the housing market. It directly impacts interest rates, which in turn affect mortgage payments. When inflation is high, interest rates go up, making mortgages more expensive. This increase in mortgage payments can push the market towards a tipping point, potentially leading to a housing market crisis. As mortgage rates start climbing, some potential home buyers might hesitate. But for savvy investors, this is actually an opportunity knocking on our doors. Here's the deal. Fewer people can afford to buy homes when mortgage rates rise. That means sellers are left scrambling to attract buyers. And what do? They drop their prices. So higher mortgage rates create a buyer's market. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keep us motivated to keep making you great content. Thank you. Now, back to what I was saying. Employment crisis. What happens to the housing market when unemployment rises and paychecks shrink? Unemployment and underemployment are not only personal crises, they're market movers. Fewer people can buy homes if fewer people have jobs or if they're not earning enough. It's simple. This drop in demand can leave house prices in the dust, not to mention the risk of increased foreclosures if people can't keep up with their payments. But here's the silver lining for investors. When the economy takes a hit and people start losing jobs, rental properties become more in demand. See, more people opt to rent instead of buying, given the uncertainty in the job market. And where there's increased demand, there's an opportunity to make some serious cash. So as an investor, you can capitalize on this trend by scooping up rental properties. Confidence in spending. Imagine a world where everyone's ready to buy a home. Now, what if that confidence disappears suddenly, and how does the fear of commitment change the real estate landscape? At the core of a thriving housing market is consumer confidence. It's all about the mood. Do people feel good about the economy? Are they ready to commit to a mortgage? When confidence is high, the housing market buzzes with activity. Homes are bought and dreams are built. But when confidence wanes, the market feels it. Hesitation creeps in and the pace slows down. This shift can either cool off an overheated market or signal trouble ahead. The supply-demand tango. Let's break down the classical dance of supply and demand. In the context of housing, this tango can either lead to a seller's paradise or a buyer's market. But what makes the difference? When homes are scarce but everyone wants one, prices soar. It's a seller's paradise. But when homes flood the market without enough buyers, it's the buyers who get to call the shots. This balance or imbalance tells us a lot. It's about finding that sweet spot where supply meets demand, signaling a market that's just right. But let's get real. This balance is delicate. Factors like new construction, interest rates, and even population shifts can tip the scales. Remember the frenzy of 2020? Low rates had everyone clamoring for a piece of the pie, showcasing how quickly demand can spike. Pricing and affordability. Moving on, we confront a critical question. What makes a home affordable? And how do pricing trends reflect the market's overall health? It's simple. When homes are affordable, the market is healthy. People can buy, the wheel keeps turning. But when prices outpace what most can afford, trouble brews. Rapid price hikes are a red flag, hinting at a market that's too hot to handle. A healthy market grows with inflation, keeping homes within reach. But when the climb is too steep, it's a warning. External factors like interest rates and government policies play their parts, shaping the affordability landscape. Navigating the challenges of crisis investing. Many still remember the pain of the 2008 financial crisis and its aftermath, the shock of seeing their investment portfolios shrink, and the worry as retirement savings dwindled. These experiences have deeply influenced how people respond to economic downturns. Amidst the chaos and fear, some investors saw opportunities, whereas others only saw problems. How did they find chances for success amid financial chaos? And what can we learn from their bravery and clever thinking? Let's dive into the first lesson, where we unravel the mysteries behind investor behavior. Do you ever wonder why losing something hurts more than the happiness of getting something new? Most money theories picture a world where everyone's making smart, well-thought-out choices to get the most bang for their buck. But in the real world, it's not always like that. That's where behavioral finance comes in, showing us how people actually act with their money, not just how we think they should. One big idea from behavioral finance is called loss aversion. It means we feel the sting of a loss way more than the joy of a win. This fear of losing can make us do some pretty silly things like dumping stocks that could make us money later, or holding on to ones that just keep losing value, hoping they'll bounce back. After the world has been shaken up by big changes, how are investors, especially the younger ones, changing their game? What clues does this give us about how big events shape the way people think about investing for the long haul? Even when the dust settles after a crisis, those knee-jerk reactions we have to scary financial times don't just disappear, they stick around, affecting how we decide to spend or save our money down the line. Take what happened after the short but sharp recession that came with the pandemic. A study from BlackRock showed us something interesting. Almost half of the millennials decided to put more of their money into stocks within that year, and a bunch of them were planning to invest even more soon after. What does this tell us? Even in tough times, or maybe because of them, a lot of younger investors are looking to take bigger risks, hoping for bigger rewards. When the market is in chaos and people are selling in a panic, that's the best time to find opportunities. Think of it as a big sale of assets. Prices drop a lot because people are scared, but if you stay calm and have some money ready, you can buy these assets cheaply. Then when things calm down, you can sell them for more. Making money during these times requires patience, discipline, and being ready to act. Remember that this isn't the end. Even when everything seems to fall apart and stock prices are dropping, history shows us that after the panic ends, people start feeling hopeful again, and prices go back up. The market often overreacts, acting scared before thinking it through. For smart investors, this overreaction means you can buy valuable things for much less than they're worth. And let's not forget the stock market isn't the only game in town. Remember the Great Recession? Home prices tanked when the bubble burst. Too many homes, not enough buyers. People couldn't pay their mortgages, leading to foreclosures and homes worth less than what was owed. For those eyeing real estate, this was the perfect storm. Buying homes at these low prices wasn't just a steal, but a strategy. As the market found its feet again, these properties didn't just regain their value, they became gold mines for those who had the foresight to invest. Short selling is like betting against a company's success. Imagine you borrow shares and sell them, hoping to buy them back cheaper if the company's stock price falls. This way, you profit from the price drop, but it's risky. If the stock price goes up, you lose money because you have to buy back the shares at a higher price. Options trading is another way to make money if you think the market will go down. With options, you can buy the right to sell a stock at a specific price in the future. If the stock price falls, you can sell it at the higher price you locked in. Buying stock options lets you profit from a market drop without actually owning the stock. Selling call options makes money if the stock price doesn't go up, as you keep the money paid for the option. Have you ever thought about playing the investment game beyond just stocks? That's right, the same clever moves you make with stocks, like betting on prices to drop or using special contracts, work with bonds and gold too. It's not open doors for everyone. Some rules might stop you from jumping in. Plus, it takes a certain nerve to bet against the market. Not everyone's game for this strategy. Why? For starters, you need special access that not everyone has. And then there's our own nature getting in the way. Most of us don't like the idea of hoping for things to go downhill. And what if you get it wrong and the market decides to soar instead? That's when short sellers have to hit the brakes, potentially ending up in a financial pickle. So it's not just about buying and hoping for the best. There's a whole other strategy of playing the market's downsides to your advantage if you're up for the challenge and know how to play it smart. The accessible alternative. If short selling sounds like a headache, there's something a bit easier. Inverse ETFs. ETFs, or exchange-traded funds, are like baskets of investments that you can buy and sell on stock exchanges, similar to individual stocks. They offer a way to invest in a wide range of assets without having to buy them all individually. Inverse ETFs are like the opposite day for the stock market. They go up when the market goes down. They're a great choice for anyone wanting to bet on market drops without the hassle of short selling. And for those who like a bit more thrill, there are leveraged inverse ETFs. These are like inverse ETFs with a turbo button, aiming to boost the gains from the market's drops even more. But let's check out another smart move for investors when the market gets shaky: undervalued properties. Undervalued properties are often priced lower than their true worth, offering a great opportunity for those who can spot them. By finding distressed properties or ones selling below their market value, you can make the most of the downturn and earn big profits once the market bounces back. You can also turn your attention to foreclosure properties. They can be a goldmine during the housing market crisis. When homeowners can't keep up with mortgage payments, properties go into foreclosure. That's where smart investors step in. They can scoop up these properties at bargain prices. By finding distressed properties and understanding how foreclosure works, investors can grab valuable assets for less. How to protect your money. Not everyone wants to ride the roller coaster of buying low and selling high. Some just want to keep their money safe. How do you do that when the market's all over the place? You can make some smart moves, and we're about to share them next. In all the chaos, some companies and stocks are like hidden treasures waiting to be found. How do you spot these gems that can make you money in the long run? We've got some insider secrets to help you out. It's like peering through a crystal ball into a company's heart, its financial health, business model, and future plans. This isn't about the here and now, it's about predicting resilience, how well a company can sail through storms based on its past and its strategic plans for the future. Now, onto a path less traveled: short selling. Imagine selling a map of an undiscovered island you don't own, betting you can buy it back cheaper later. High risk? Absolutely. But the potential rewards match the risk for those who can decode the market's cryptic messages. A word of caution though: misinterpret these signals and you could be swept away by the tide. Traditionally, if you're thinking about venturing into real estate, it's a refuge during economic squalls, but beware, the seas here can be tricky. Falling interest rates, the allure of bonds, the pressure on stocks and real estate, and the specter of over-leverage. Navigate wisely, focus on properties brimming with potential, and real estate could be your treasure trove. The economy has changed a lot because of the recession. We've seen job losses, businesses shutting down, and people spending less money. Despite these problems, some areas like rental markets can still do well. However, if you're investing in real estate, you need a strong financial foundation, reliable money coming in, and the ability to handle changes like tenants leaving or personal money problems. When things are uncertain, your investment plan needs to be very strong. What are your best tools? A good credit score, solid proof of income, and advice from experts. Working with financial advisors, real estate agents, and mortgage experts is the smartest way to get through tough times. Don't be scared off by the markets and economy's ups and downs. With the right knowledge, a solid plan, and good advice, dealing with the complexities of the market can be manageable. Investing during a crisis takes bravery, wisdom, and patience, but it can be very rewarding for those who are careful. You should also set up an emergency fund for surprises like these. Having cash you can quickly use means you won't have to sell your investments when their prices are down. This is about keeping some of your money in places where you can grab it fast, like in a savings account or short-term bonds. Economic downturns are tough, but full of opportunities for savvy investors. You can protect and grow your investments by focusing on basics, using strategies like short selling, and being cautious in real estate. Success in a volatile market comes from managing risks wisely, not avoiding them. With smart planning and expert advice, even tough times can lead to financial growth and stability. Thanks for watching, and please make sure you subscribe if you enjoyed the video, and watch this one as well.